it's impossible to guess where we're going because we are pretty much being driven by Trump. And Trump, at least for me, he's proving to be kind of not predictable. The one thing I know is that he will flip stance quite a few times. That's about it. Unfortunately, I wouldn't be surprised if this is the beginning of a very strong bearish trend.
Hi everyone, welcome to Bits and Bips, exploring how crypto and macro collide, one basis point at a time. I'm your host, James Seyffart, TradFi Archmaester, Lord of Bloomberg's End. I'm here with Alex Kruger Macro of House Asgard, Protector of the Realm.
Yep.
Also with Ram Alawalia, Maester of Wealth, Leader of Lumida.
How's it going?
And today we're joined by Travis Kling, Grand Strategist of the Ikigai Treasury.
Here we go. Thanks for having me. Hi, guys.
Thanks for being here, Travis. We're here to discuss the latest stories in the worlds of crypto and macro. Just remember that nothing we say here is investment advice. Please check unchainedcrypto.com/bips and bips for more disclosures.
Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing.
All right, before we get into this bloodbath of a market, Travis, why don't you give us a little background about what you do, who you are, why you're relevant to the crypto and macro space? I'm very familiar with you personally, but we'll see if everyone else is or not.
Yeah, I'm not relevant. I'm actually applying for jobs at McDonald's, so I'm not really sure how I got here, but
you're a long-term investor now, right?
Yeah. Community member. I'm a community member. Yeah, founder, CIO of Ikigai Asset Management, crypto hedge fund, launched it in 2018. Most of what we do is quant trade, BTC, ETH, and Sol, although we kind of do bits of a lot of other stuff as well, too. Before I jumped into crypto, I was in traditional hedge fund investing for a decade. I was a portfolio manager at Point72 before I jumped into crypto, energy, mostly oil and gas. So that was my prior life. Yeah.
Fascinating. Well, it's extremely relevant today because, as I kind of hinted, we're recording this on March 10th. It has been a bloodbath of a day, a bloodbath of a weekend for the most part in markets. Maybe I'm being a little hyperbolic, but I mean, everything I look at on my monitors on my Bloomberg terminal is red. It's not just crypto. Everything in crypto, all equity indices, everything just does not look great, to be honest. Bitcoin below its 200-day moving average. But before, I'm not even going to keep rattling these things off. I'll hand it over to Ram. What is your reading and summarization of what's going on here right now in the markets?
Yeah, look, if you want to frame it up, going back to the Trump's inauguration, you had peak Goldilocks, or as Trump likes to say, peak golden age. And he was at the UN saying we need to lower rates. And it was an America First speech. And fast forward, the United States is lagging all international indices. Europe is leading, although I think Europe and Germany may have rolled over today. And we've gone from a Goldilocks narrative to a growth scare and recession concerns. Those were exacerbated over the weekend when Trump had an interview with Maria Bartiromo, who said, "Do you think we're going to have a recession?" And he did not respond with confidence, which is what you're supposed to do as a president. I think the exact quote was, "There is a period of transition because what we are doing is very big." He did say, "I hate to predict things like that." Now, it reminded me of in September 2008, when George Bush gave a primetime TV address. This is in the middle of the financial crisis, but we had not seen October, which is the real depths of the financial crisis. And he introduced the public. He said, "Hey, be calm." And of course, the public did the exact opposite. And I think you have some of that here, right? A lot of small business leaders look to leadership to inform their point of view. And you're starting to see weakness in different confidence surveys. Of course, the sentiment surveys are all washed out. They are at significantly, negative 2 standard deviation levels. The VIX was around 29 today, as kind of begrudgingly stepping higher at a slow pace. and you had markets gap down open and close lower, which was a reversal of the kind of patterns that you've seen in the prior weeks, where essentially investors were trained to buy the dip. You've seen put call ratios spike, but it hasn't mattered. And partially, I believe that's because people are chasing every dip. So overall, you've also had this commentary from Besson and Trump saying, we're not focused on Wall Street, focused on Main Street. Wall Street's done well. Main Street's about lowering mortgage rates and lowering the 10-year, and the 10-year is not responding fast enough. The 10-year is like 4.2%, barely budged in a brutal day for the market, which is what you don't want to see. You want to see the VIX blow out to 35. You want to see the 10-year go to like 3.8. So that's where we are. I think the market needs to see earnings next month. But it's all the technical trends are broken. Every weekend, my team and I, we go through every theme we can look at. Bitcoin's below the 200-day moving average. Aside from pockets in healthcare, every trend is down. And it's easy to spot short opportunities and not easy to find logs.
Yeah, I mean, the 2-year is down lower than even the 10-year went down off of all this stuff. The 2-year is down at 3.8, which I guess isn't a huge gap from the 10 at 4.2. I see 2.1, 2.2, which again, I agree with you. Like that's that's the only thing being bought today. I said everything is red. I mean, yields are red, but that means treasuries are being bought. Travis, you're a trader here. What do you disagree with anything Ram said, or do you have any further thoughts that you could tag on to what's going on in the markets?
No, yeah, I mean, I think you can broadly characterize it as Trump uncertainty, and there's just a lot of moving pieces. And like a lot of cross currents that go along with the moving pieces. And I don't know if there are people out there on Twitter or wherever that are like espousing a high degree of confidence about how they think the macro landscape is going to play out. I don't see how that could be possible right now, to have a high degree of confidence and understanding kind of. There's just too many factors that are moving around. I don't know how much you guys have been talking about that recently, but you just think of all of the different kind of mandates that this administration is running with, and then you try and sort of roll those through and think about the impact that each of them have on inflation, GDP growth, labor markets, and debt level type of stuff. And you look at, okay, what does it mean for DOGE? What does it mean for tariffs? What does it mean for, peace in the Middle East or lack thereof? What does it mean for illegal immigration coming out? Like, and you just try and take all of these different mandates that he's obviously run incredibly hard on. I don't know how many executive orders he signed at this point, but it's like a Fitz 50 or something. It's smash the prior record. And then you try and go, well, how do all these things shake out net into those 4 buckets that I just described, which is kind of like what financial prices care about. And I don't know if one of you guys have like a clear picture on what that looks like. I don't have a clear picture on what that looks like. So the market's just getting kind of freaked out about it. James, before we started, I'd asked you about this, Alex or Ram. I don't know if you have any insights or commentary on this, but it is my understanding that in like traditional, like multi-manager hedge fund land, that there is like a big kind of factor-geddon is what people are calling these sorts of things right now. We've had a few of these previously, and just, particularly I think in momentum and crowded, those 2 factors have had just some massive wipeouts, which we've had things like that before, because these kind of factor bar beta, multi-factor VAR risk models, these are now how trillions of dollars of capital gets deployed on Wall Street. And it's just kind of this weird thing where, capital gets like, and leverage just get ratcheted up. And you have something like this, and you'll do like these periods of unwinds. I will say that, and then this will be the last thing I'll say about that, factor getting stuff, generally you can have more insight. You can have some amount of insight into when those things are getting close to the end. And like prime brokers, JP Morgan and these guys will put out research because they see a lot of the stuff from the back end about what's happening with these unwinds. And, and I think we're probably getting pretty close to that. And the market may get some relief as some of this like factor getting stuff chills out. That's a lot easier, I think, to get your head around and see sort of like a light at the end of the tunnel relative to what is this Trump administration going to do, basically.
I'll chime in briefly. I want to get Alex's view here. So if you share the screen, James, so you're right on. So we use factor models all the time to analyze what's working and not working. And I did a back test over the weekend of the momentum factor. So what you're seeing here is
momentum's
what
breaking.
happens if you own securities that have high momentum and rebalance every month. And two takeaways. One is it's dramatically crushed the S&P 500 since the rally began. Observation two, it's got hammered. And well, what are the stocks in this? These are thematic stocks. So data center, NVIDIA, Palantir, Robinhood. So themes in general have been getting crushed because themes are stories. People like a good story and they've been buying stocks based on these stories. And, Palantir's only got a 300 PE ratio now. So this is different than other corrections. It's a momentum correction, that's right. But the valuations here are coming at a much higher level than they did in the past. So, JP Morgan, to your point, Travis, said that we're 90% through this momentum correction. I do think we're due for a bounce with the VIX at 29, but I do think the bounce will be sold. And you want to really orient around quality value. Like Costco, Walmart selling off too. Those are bubbles.
The one thing I think of when I look at this stuff is like, this stuff is supposed to be market neutral, right? So like all the stuff Travis was talking about and kind of what you were talking about, Ron, most people think of momentum. They usually go in the long, the names, as you said, but also shorting names that have like bad momentum. But like, it looks like even market neutral stuff is doing bad, which kind of seems weird to me because in my head, it really would do bad when you have like, a junk momentum rally, things that have been doing bad start doing really well. And the things that were doing well start doing bad. That's when you see that massive dip down, but it doesn't really matter. Everything just kind of seems to be like, all those cross currents are causing a lot of issues.
Guess what the best sector today is? Energy.
Energy.
It's what the worst performing sector was over the last few years after 2022.
Energy.
So energy, exactly. So if you're a quant and you're long momentum, means you're going long high momentum stocks and shorting negative momentum stocks so that you're dollar neutral. The crazy thing is like AQR has rolled out products recently to enable more of this factor investing about a year ago. And so it's significant. I think the damage that's being done out there. And the other thing I would say is there are good businesses that are trading cheap, but it doesn't matter. If it's caught up in the wrong factor mix, like if your house is in the wrong neighborhood, it doesn't matter how much free cash flow you have. Like it's getting taken out. Like it is, there are businesses out there with like 12 times PE and 20% earnings growth that are not doing too well.
So you're saying those are buys today, right? Right.
I don't
Theoretically,
think
should
now. I think
or at some point in the near future.
Yes, sometime this month, correct. But you have to navigate this carefully because the momentum factor is under a lot of pressure. We got the VIX bounce. But even when we had these Friday bounces, those momentum names haven't participated as they should have. They've been laggards. So it's working on things like healthcare, defenses, consumer staples. We saw staples actually have a down day today, but in general, defenses, utilities, which are essentially bond proxies, right?
Yep.
That's overall what's been working.
Alex, you're as active a trader as I know. What are your thoughts on everything we just talked about? Like, do anything you disagree with? Or are you kind of in everything's going down? How short are you right now?
No, not really. The first one is this is no, I'm scalping. I'm scalping, and I'm going. I think we're going to see a very, very significant rally driven by tech tomorrow, Tuesday. What I'm thinking, the first thing is this is entirely Trump driven. It's important to recognize it. Especially, I think it's important to actually do some sort of mea culpa about basically misreading the level of aggressiveness Trump would push through at the beginning of his administration. It's been dramatic. It's Trump driven. It feels like he's an 800-pound gorilla that got into a house, just tossed everything around, took a big dump, and he's still there. When it comes to basically what's going on right now is equities driven. I really think we're gonna see a very strong relief rally tomorrow, which is not that relevant for the audience because we release this 2 days late on Wednesdays. But this today was driven by the Trump investment comments, and it was pretty much, you could see like a very strong unwind, and it went all the way back down to a very important level options wise on the S&P, which is basically around 55. It is 55, 65. That was the number. We went right straight into it, and then we got a very big bounce at the close. I really think that like a bounce when you have such a big move of small headlines, and something that's been going on for already 2 weeks, it kind of makes sense. Then you go into Bitcoin, and what you see on BTC is you see a book that is like really stacked with basically limit orders, buy orders, basically from 78, now 77 all the way down, like really thick, both on spot and perps. And on the upside, it's pretty empty, which is something you usually see when you have such a big move, right? So what we want to see right now is some sort of, ideally a catalyst tomorrow, some sort of comment. But I think it's going to happen regardless. That being said, very important is I'm with Travis. It's impossible to guess where we're going because we are pretty much being driven by Trump. And Trump, at least for me, he's proving to be kind of not predictable. The one thing I know is that he will flip stance quite a few times. That's about it. Unfortunately, I wouldn't be surprised if this is the beginning of a very strong bearish trend. And it depends on Trump.
I agree with the Trump comments. I mean, that's where all this started from. And I would add to it, though, there is some data showing softening, right? If you look at the Citigroup Economic Surprise Index, you're getting more misses. We're also seeing, more recent inflation prints remain elevated, which puts, the Fed in a bind. Now, Powell said a few days ago that, they'll likely, relax and respond if conditions warrant. But they want to do it this coming month. We want to see how CPI reports, later this week. But all to add is that there is softening underneath the surface, and there was softening, going even into the Trump election. We're just seeing that start to express a bit more here.
One thought on that is a little bit of softening actually could be considered good because you get sustained growth just lower, and you get basically less pressure on the inflationary side. So a little slowing down was not an issue. The issue is basically Trump and the uncertainty he brings in. It's more than just the tariffs. It's the level of uncertainty, the back and forth, the getting into pissing matches with foreign dignitaries, same with banks. It's like we don't really know where we're standing. Comments about recession, comments about Main Street before Wall Street. Okay, this is the kind of thing you don't want to hear. It's like you can think about it, just don't say it.
Yeah, it goes back to what Travis was saying. It's really like you have like 50 different streams that are coming out of their mouths or like coming from people in the administration. And like one thing's inflationary, but this thing could be deflationary. This could be good for job. It's who the hell knows what's actually going to happen aside from somebody possibly in the administration.
Well, everything right now is front loaded on the bearish side. In fact, the word that was used was detox. Besson used the word detox on CNBC. So what they're front loading is tightened labor supply, tariffs, and austerity. So the tax cuts come later. The deregulation we haven't seen yet.
I want to say something there. I think it's a problem. The one on deregulation. It's on the first term. We got deregulation from the beginning. We got the tax cuts before the tariffs. This time around, I don't know why he's doing exactly the opposite. So he didn't really prepare us for the market.
Doesn't he want to lower the 10-year? Isn't that the operative theory? Lower mortgage.
I don't buy that theory. I don't think I really do not buy that theory. The theory is that they're trying to engineer a recession to lower the 10-year.
I don't know if they're trying to engineer it, but like, so Besson has said several times, including this Friday, we're not focused on Wall Street, focused on Main Street. And he's saying, look at the 10-year, it's come down. Look at the spread of the mortgage rate above the 10-year, it's come down. And he also said, in a month, we will have unlocked the mortgage market. Now, the only way you unlock the mortgage market in a month, if the 10-year really comes down, which doesn't help asset prices. Then someone asked Trump, do you look at the stock market? He's like, no, I'm not looking at that. And then the spokesman had come out and say, or Besson came out and said, Trump looks at many pieces of data, one of which is the stock market.
Travis,
did you guys see the clip from Steve Cohen like last week or the week before? You don't see, he's not in front of the camera that often. And I did just notice that, where he just was describing it as austerity, which was like the first time I had heard somebody. I mean, that is what it is. DOGE is that, but it was like the first time I'd heard, for like just that particular word. I feel like that word is so loaded for financial markets people. You go back to post financial crisis, European Union and the pigs, right? That's what you think of when you think of austerity. But I mean, DOGE is that. And there is this big question mark. I remember right when he got elected, it was like the simple math was government spending is 25% of GDP. And if you cut out 10% of government spending, all else equal, simplistically, that's a 2.5% reduction in GDP, also known as a significant recession. Now, TBD on what exactly the pace of the outcomes of DOGE is going to be. I did see like a one-off tweet from Elon saying he thought he could get $1 trillion out of the deficit for 2026. It's a $2 trillion deficit. He said he thought he could get $1 trillion out of the deficit. I don't know. Maybe he was taking, I don't know what he meant by that. But, and then also when you're looking at a lot of the stuff that they've been announcing so far in DOGE, there is a question of like, how does that stuff actually roll through GDP? I mean, a lot, it's like, you're putting on a play for, whatever, like trans puppets in Iraq or whatever. Like, it's like, that's not something that hits GDP. And so, so it's hard to say if they're really pulling a lot out with DOGE. It's hard to say, how does that roll through inflation, labor, and GDP? I don't know. Yeah. I'm not sure. Some of it seems so wasteful that, if you're just taking a pile of money and setting it on fire, and then you stop setting the money on fire, does that ding GDP? I don't think so, but
I'll take the other side of that. But Ram, you go first, and then
I'll be brief. I think I'm all for the DOGE cuts. If you take an unproductive government worker and they get a job that adds value to the economy, it's net positive for GDP. That's one. Two, to your point, Travis, they've got to pair it with the tax cuts, so there's no net impact on demand, because the key is Trump can drive small business confidence, which is where most jobs are created. That confidence peaked shortly after he was elected, now starting to come down because of the anxiety around living room presidential politics and geopolitics, which people cannot handle, right? I've had conversations with people that just volunteer this to me where they otherwise wouldn't, as a form of therapy. I'm like, I haven't seen that before. So here's another comp I've been looking at. One is 2018. So in 2018, you had three things. You had China trade wars, check. You had growth scare concerns, check. And you also had a Fed that had just recently concluded these adjustment hikes. Now, we don't have that here, but there's a lot around what's the Fed going to do? Is policy restrictive, easy? So what happened in 2018 is you had a 19% correction. And my team and I over the weekend are like, all right, at the 10% level, given what we knew at 2018, would you have bet that prices drop further or that you get a recovery? And so this chart here shows how 2018 unfolded. You see a steep, sharp, sudden drop. You had a rally when the VIX hit around 28. That rally lasted about 1 week, then it rolled over again. That rollover was about a week and a half, 2 weeks, bounced again about a week. And then you had this capitulation down, which was 2 weeks of pain, and then a sharp V-shaped recovery. That recovery started when the VIX broke the 30s, which is kind of what I'm waiting for from a sustained recovery. I think the market kind of wants to puke, I do think you get a bounce soon, but the bounce will be faded just like this. And I see that, when you look through hundreds of these different charts, they are going to rally into short-term resistance. People will sell them, and then they will then continue downward until valuations are compelling. The key difference between 2018 and this is that the stock market is about 20-30% more expensive than 2018.
I think there's another difference there, which is 2018. That was driven, the way I see it, was driven all by Powell. Powell basically on that there in I think it was September 30th, maybe, when the move down starts. Powell says, we are far from neutral. And just basically hell breaks loose. And we go basically driven on the back of the perception of a very hawkish Fed. We basically crashed all the way into Christmas. Then we go into the FOMC in December. We keep on puking. And ironically, by I forgot who was New Year, so exactly what it maybe it was Christmas on the 25th. Trump comes out and says stocks are cheap. This is the time you go and fucking buy the dip, right? So now it's Trump, not Powell.
I guess you're trading off a hawkish Fed on the one hand with high valuations and growth concerns, right? The GDP is clocking in now at a 1+ annualized right now. By the way, I don't think we're going to get a recession. To be clear, I don't think that's going to happen. But the backdrop that we've all discussed here, it does not help at all. It just doesn't help. And there's reflexive qualities to markets.
Do any of you guys have a strong view on the directional path of like just CPI inflation from here, like over the course of this year? You think down, huh?
Oh yeah, it's coming down. Well, you saw that hot print we saw last month, but okay. Let me tell you the other side of this story. I got a chart that I can show you here with the inflation levels, and it has been elevated recently. But if people are pulling back and oil prices are coming down, and oils are at 60, right? Then you've got defense cuts, you've got less labor pressure. I think in the near term, actually, it's coming down.
We know the shelter component is coming down because you can look at that the Zillow lead, right? So that's basically set in stone, I think, for at least the next 9 months. The housing component is coming down. But it's I don't know, eggs quadrupled in price or whatever just happened to eggs. So there's offsetting stuff. And then when you try and think about the labor market and tariffs, the labor market as it relates to, I mean, that's what I mean. It's just so hard. It's what is rounding up however many illegal immigrants we're going to round up and send them home? What does that do to the labor market?
They're moving too slow on that. So if you look at this chart, James, this is the contra argument. This shows the CPI headline, and you can see it's going up. It's going up. But I will maintain that inflation will come down because a lot of these are one-time annual price increases you get at the end of the year. Think like your Netflix subscription goes up, or Progressive Auto Insurance raises their insurance costs. That's behind us. Those are the January menu price increases. Now we should start to see this go in the other direction, which is good. That gives more flexibility to the Fed.
Yeah, going back to kind of, I'm not as staunchly in belief that it's going to necessarily go down. I don't think we're going to see there are people that think we're going to go back into an extremely inflationary environment. I'm not quite there either. But going back to what you were talking before, Travis, for everyone who's listening, if you took economics, the GDP textbook formula is C plus G plus I plus NX or net exports, right? So consumption, government spending, and investment. And if we're really going to decrease that G, like you said, Travis, you said, yeah, we're decreasing stuff we're spending overseas on puppet shows in Iraq. But also, if we're really going to get rid of some of this fraud, believe it or not, that money is going to people and people are probably spending it. It's part of the economy, right? So what we're talking about here, the tariffs, I know Bessent will say it's not inflationary, but no matter how you slice it, it's an increase in price. Maybe it's a one-time increase in price, but who knows what the second, third order effects will be. You're talking about immigration. That's almost certainly inflationary. But as Ram said, it's not going as fast as like Trump was talking. He obviously wants it to go faster. But then you take into account they're trying to cut government spending left and right anywhere they can, which also not going as fast as they wanted to. I don't think. Like if you look at some of the DOGE numbers, some of them are really sketchy about whether or not they actually count, and like it's just not really. It's moving the needle. I'm not going to be the person that sits here and says like saving $100 billion is nothing. Like there are people out there saying like it's pointless to do this because it's not actually moving the needle in a major way, as though like saving a couple $100 billion is not a meaningful use of anyone's time. But we don't need to go there.
Those people are losers.
Yeah. But yeah, like you cut that G big enough. The second, third order effects are definitely going to be deflationary towards what Ram was talking about, I would say, because of the second, third order effects of where that money is going.
Hard to cut G, don't forget as well. Like I hope they can cut G a lot, but you need acts of Congress. You're already getting pushback from agencies. I think there's a puzzle out there, which is why is the 10-year stubbornly at 4.2? It dropped from 4.7 to 4.2. If you have lower growth expectations, you should have a lower 10-year, right? The 10-year, approximately, a good rule of thumb, is the sum of the inflation rate and expected growth. And you're not seeing that come down, which I don't like. I don't like to see that. Like the same thing. I want to see the VIX jump higher, and that bothers me because the 10-year is still attractive as an opportunity cost to holding risk assets.
Two more things I just want to throw in terms of complicating any kind of inflation predictions. One is on the inflationary side, if they end up not taxing tips and overtime, which you have heard that soundbite multiple times. You want to talk about like tip of the spear inflationary. It's like two of the most tip of the spear things I could imagine doing. Again, don't know the likelihood of whether or not that happens, but it's been repeated by Trump. It's been repeated by Bassett, I think multiple times from both of them. So they seem pretty serious about it. And then I would say one more thing I'll throw in, just not that I have a view on it because it's so confusing, but supposedly DOGE is going to get pointed at Medicare and Medicaid here pretty soon, which is like the ultimo, it's like if USAID, we're talking about B's, you move to Medicare and Medicaid, it starts with a T, right? Insane amounts of just like, that's like the ultimo grift, right? And I don't know, I have no idea what's going to come of it.
What do you think that means for when they say they're going to point to Medicare and Medicaid, which are obviously the two biggest entitlement programs after Social Security, where Trump has already said he's finding people that are 300 years old getting checks, and many, many of them. What do you think that means? Like there's policy, which is on the one hand, that has to come through Congress and the agency has some control, but the other would be like waste, fraud, and abuse. Do you think that they're going to find a lot of waste, fraud, and abuse? I wouldn't be surprised, by the way. There's people, if the government's writing a check for meeting out some criteria, remember like the CARES Act or the PPP plunge protection program, not the plunge protection. It was
paycheck protection program.
Thank you. The plunge protection program is called BlackRock. That's the right? I got them mixed up here, but that you had a lot of fraud and abuse there. So I'm curious how you think about the Medicare, Medicaid. I think it's right on, by the way. I'm looking at that too. Go ahead.
Yeah. I don't know the scale of that. I guess the little I know nothing about healthcare. I've got buddies that are in it. Every time I talk to them, it's just this enormously complex. It's like, seems like such a mess, right? But the little simplistic thing that I hold in my mind is like the whole thing where, you have insurance and then you take an ambulance to the hospital and then they fix your broken arm or whatever. And it was like $6,000 for the ambulance and it was like $20,000 for your broken arm. And then it's like, you don't have insurance and then you haggle with them and they're like, all right, $500 for the EMS ride and, $1,000 for the arm or whatever. Like just immediately they can just make like 90% of the cost of this just like disappear. And it seems, again, a layman on this stuff, but it just seems like it's indicative of this like insane amount of just fluff. I don't know how to describe, that. And again, not an expert at all, but
I had my appendix taken out 2 summers ago and I had insurance, but they gave me a quote unquote bill so I could see, and it was like $20,000. And what the hell? And I was out within 24 hours. I went in Saturday night. I was back home Sunday at 11 a.m. So yeah.
Right. I mean, They're going to try. I'm sure they'll find stuff. I mean, the Odd Lot specifically, a Bloomberg podcast that I'm not sure if you guys listen to it, but like did an episode strictly on like Medicare fraud. There's like all these companies that spun up because they set up this program that was like for good reason to help people that need like an ambulance ride to the hospital. Like Medicare will reimburse that for certain situations. And like they set up this whole process to do that. And then all these people spun up companies to give like pseudo ambulance rides to bill for it, even though they're really not full ambulance rides. And like, yes, it's needed, but there's a lot of fraud. So I think that when they say they're pointing there, I think they're looking for things like people are billing this much money, saying they're doing X, Y, and Z, and they're going to try to use data science, AI, whatever, what have you, to look for like pockets of this being misused. I don't think they're going to point there and like, cut the spending by like any meaningful percentage. That's my just personal view.
Hi, everyone. Matt Hogan again, CIO of Bitwise Asset Management. Are you wondering if this current market pullback marks the end of a cycle or just a pause before another bull run? In my latest CIO memo, I examine what the market has missed in the executive order establishing a strategic Bitcoin reserve and why it's really set us up for new all-time highs over the long term. Download my latest memo at bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
And going back to rates, I mean, you were talking about like you don't know why the 10-year isn't down any lower. I mean, it's like you said 4.2-ish, but the Fed effective rate is still 4.3, 4.5, right? So like technically speaking, the Fed funds rate is pretty high.
The long end should be responding to risk off conditions and lower growth expectations. It's odd. It's odd. I would say that and the VIX are not they're not responding to kind of the recent risk off environment in a way it normally would have. Like, I don't know, Alex, you're probably staring at the VIX like I do.
To be honest, to me, VIX 27 and the way how the curve is backwardated right now, meaning short VIX is, I mean, no, it's not that it's bullish. It's, eventually it means reverts, but and the curve and inverts. My point is, to me, actually, I'm not surprised. I mean, they are in line with what I would expect. VIX at 27 right now. What is it? Yeah, 28.
So I'll tell you this: I was essentially staring at the VIX pretty much the whole day, which is what you do if you're trying to, target positioning. And I see Travis smiling there. You guys know what I'm talking about. But in the August correction, the VIX was just very responsive, like a spring. You have a down day, VIX shoots up, and here, it's like 26.2, just steady, and it's bleeding out. Then finally go 20. It was just very, it wasn't as responsive. I think part of it was because so many people have hedged. The put call ratios are off the charts. So it's a different dynamic than we saw in the April correction and in the August correction. So markets finding a way to shake as many people out of their positions, whether they're hedged or not hedged.
So
one thing on the VIX, just quickly, 30, we traded 30 today, right? I think 29 something.
29.
It is very high. Historically, it very rarely goes above 30. Like it happened, let's look at it going above for more than like 1 day. It happened in August. That was 1 day. 2020.
We busted through 30s. We got like 38. I think it closed on 1 day, but it got as high as like in the 50, 60, 70, which is extraordinary. And I think zero DT options might have a role to play. I'm not sure, but I think there's a puzzle. There's an Odd Lots podcast to be done there.
Yeah. So sticking with macro before we get into a little more crypto specific stuff, because we probably should at least talk a little bit about the the Bitcoin reserve and the crypto stockpile. But first, we have a CPI print for February coming out on Wednesday. Travis, you kind of talked about it. You're saying the one thing you were saying before, which I agree with, is like the real estate is kind of going to be part of that, is going to be going down no matter how you slice it, just because of the way it's lagged. And the Fed often talks about that. And when I hear them talking about it, I'm like, why don't you change the way that you're doing it then? Like, if you're looking at the forward looking stuff, the way that all of us are looking at it, why are you still allowing whatever? That's a different side chat. But What do you guys think? Do you think the print on Wednesday is going to matter? Are you like even at all thinking about it, or are you just kind of looking past it? Like, what do you like? Usually CPI print the last few months, like the last few years, that was like the biggest like macro data point we could get. That was moving markets, and I feel like nobody's really paying that close attention to it. What do you think, Rom?
I'm processing that question real time. I'm trying to sort out, is good news or is bad news bad news? And I think good news is good news and bad news is bad news in this environment, because there's a question around where are we on growth? But the reactions have been unusual. Remember last Friday, we had the non-farm payrolls report come out. Broadly was in line, missed by a little bit, but the noise around these estimates are significant, and the priority initial claims came in just fine. And yet markets had a small gap down red. And markets are not responding, in unusual names as news data. I think the technicals and positioning have more to do with how markets are behaving than any given data point. We had 2 good data points, and here we are, we're lower than last week, and everyone's buying the dip. That's you see a gap up, but the worst thing for the market is you see a gap up open, people sell into it, and then it closes lower. So I think that's the more important variable. Obviously, look, if the CPI comes in hot, it's risk off. I don't think that's good. If it comes in lower, I don't know if it has as much impact on the markets, and we'll see. I'm still processing. That's a really good question.
Travis?
Yeah, how many cuts are left in the curve for 2025 right now? Anybody have that in front of them?
Yeah, I do have it in front of me, actually. Right now, we're pricing for 3.3 cuts by the December meeting.
Okay.
So at least 3 right now is what we're pricing for. We got down to like less than 1 at one point.
Okay,
right
I was going to
1.
say, so we've put like 2. I was just about to say, so we put like 2 more cuts in
the last couple weeks.
Like
yeah,
2 weeks. Yeah. Okay. Yeah. So it seems to me like that would simplistically, risk assets are going to be pretty much circled up around that. If inflation starts to trend higher for all the potential reasons that we just talked about, again, I do not have a strong view on whether the likelihood of that's the case. And then you got to go from 3 cuts back down to 1 cut or back down to 0 cuts for the rest of this year, because the Fed's stuck. They can't cut if inflation is just not doing what they want it to. And then it's like, does it keep going? And at some point, I don't know, this summer or something like that, the Fed fund futures curve maybe starts to price in a hike for the next move and not a cut. And then at some point, do we just get Powell steps up to the podium and just gives us, some kind of brutal, like the day after Thanksgiving in 2022 when he was like, now, or 2021, when he's like, now's the time to retire transitory. Do we just get some kind of moment there where he's got to communicate to the market that it's like, no, it's looking like the next move is actually may have to be a hike? And again, I don't know the likelihood because there's so many of these moving pieces that we've just talked about that go into it. But you can understand how just kind of risk broadly would just be skittish about that because there's just so much uncertainty, so many moving pieces.
Yeah, the inflation fears have me like thinking for the first time in a long time that like, I can't remember the last time I thought like it wouldn't absolutely shock me if like somehow the next move ends up being a hike or like, I don't, because of all the concerns about like the different things they're doing. But I'm still in the camp. I think we're going to get cuts later this year. I've been in that camp for a while. Alex, any thoughts on inflation CPI?
Well, I don't think it matters.
Yeah.
I think
okay.
it's short-term noise now. Now we're trading Trump. It's and Powell doesn't react to one data points. He's been very, very steady on highlighting that. So yeah, definitely like a point to miss or beat on month inflation would move the market a lot, but it doesn't change the trend, which is being driven by Trump. I think on the Trump thing, the most important, I think, what we have to be paying attention on is if he starts talking about tax cuts. If because of this strong move down, if he without being very specific, if he changes narrative and he starts talking about tax cuts, which are not something that we're not expecting it right now. This is something for later on. So it's kind of like bringing forward something that he's reserving so far for later in his administration. So fingers crossed.
It's a great point. It's always important when markets are down like this to find what the bull case is and what the headlines will be in the future. Druckenmiller says, like, show me the world 2 years from now, right? And then work backwards. And yeah, I mean, tax cuts are a bullish story. I'd say the other bullish story is peace deal. That Trump wants to get a deal done. Will we get one soon? I don't know.
That's so hard. That feels so hard. Those conversations.
It does feel hard.
Yeah.
Like in the exercise of envisioning what that bull story looks like, it's peace deal, it's tax cuts, it's inflation is low, and no tariffs on Mexico and Canada, and the world lowers their tariff barriers too. That's the home run. That's all very hard, by the way. That's the outline of what recovery to all-time highs, would look like in the next 6 months or so. I would say, on the peace deal, like I don't think that's. I agree, it's hard. Like the U.S. is withholding intelligence to Ukraine, which I find distasteful and horrible. There are people that are allies that are surrounded and flanked on both sides by Russians who are probably going to get slaughtered. But you don't do that action if you think you're close to getting a deal done, because that's an action that hurts the relationship.
Yeah, I mean, with regards, I agree with what Alex was saying. Like everything is, it's being treated around Trump, and we've said this on this podcast many times before. Like my view is just like we went from Biden like never being around and like just being silent and kind of like being like a grandpa, and now like I just want Trump to not be in the news for like a day or two. Like I feel like every single day it's something new. And going back to what Travis said, it's like there's a lot of like flip-flopping on basis here. And like we saw last weekend him tweet out, which we talked about on this podcast, he was going to do a Bitcoin, he was going to do a crypto strategic reserve, and said he was going to do Cardano, Solana, and XRP, and then like later followed up with Bitcoin, Ethereum. I still would love to know what the background is that. And then all of a sudden we get the actual language of the document later last week. And it's like, it's just a Bitcoin strategic reserves. Everything else is going to stockpile. The only thing we're going to try to acquire really is going to be Bitcoin. And it's like, did Trump actually believe what he said on Sunday, or was he just doing it without talking to David Sachs and whoever else might have been in charge?
That was such a joke of a crypto conference. I mean, first of all, David Sachs did a fantastic job. That's how Zelensky should have communicated to Trump. Yeah, like his opening speech was just, he really hemmed it up there. Like, great leader. Like, this is thank you for it. Was a really inspiring speech. He did a great job. I mean that as like a compliment, right? But it was so over the top. And it's what but then Trump near the end, he's like, what did he say about Bitcoin? He's like, well, some people say you should never sell. He said, I'm not sure if I have that view. I'm like, no.
Yeah, he basically was like, we'll find out or something. It's been true so far.
You're supposed to inspire confidence, project confidence. It's all, markets are all psychology. So we were short MSTR. I saw that. I was watching it live, and I told my team, I said short MSTR and GDLC. It's a bunch of altcoins in the public markets that rallied to the moving average. So, I think trend is down. Bubbles have burst. That the main trend is that many bubbles have burst. Whether it's Bitcoin, whether it's Costco, Walmart, Palantir, Robinhood. Tesla's down 45 or 50%. And I don't think it's done bursting. It's a difficult position because there are bargains and opportunities that we talked about. So part of it's a question about positioning, but the other question is, can those opportunities deliver while you have these large market cap stocks that are deflating? Mag 7 is down in a correction worse than 10% too, for example, right? And I don't know. I'm not so sure about that. I go back to that 2018 example, because when people have an increase in risk aversion, they move into shoot first, ask questions later. Now, notwithstanding the near-term technical bounce. So it's a very complicated picture.
So on Bitcoin, so when the ETFs launched, I think it's totally accurate to say that price discovery for Bitcoin changed very meaningfully as a result of the ETFs. You just brought in you now had access to this financial instrument to a totally different magnitude of capital. We all know what the inflows look like. We also know that there's a lot of noise to inflows with carry trades and things like that. But there was also a lot of just directional buying of Bitcoin through the ETFs. And price action has changed a lot since we launched ETFs. Since the ETFs launched, we've had, I think, a 30% drawdown is max, which is basically exactly what we have right now. Like as of this morning, I think we did right at 30%. And we had a couple more that have been in like the 20s, 25s, high 20s. I think the yen carry unwind was, 27 or 29 or something like that. So all in this kind of range, right? And we're right at the bottom of that. But what I will say, so the way that I would characterize that is that you have this new type of buyer for Bitcoin that is a buyer on dips in significant size. And I think that again, some of the noise in the ETF inflow data notwithstanding, when you go back and look at some of the pullbacks last year, you can see that there was some response in inflows in the ETFs that kind of formed the bottom in that, whether it was Germany selling 50,000 BTC in July of last year, yen carry trade unwind, obviously big bounce in all markets off of that, huge bounce in all markets off of that, Bitcoin included, ETFs had solid inflows off of that. But all of that, so this new kind of buy the dip buyer in size that now exists through these ETFs, they have had generally a constructive macro backdrop for that entire period of time. Since January of 2024, we've been in a generally constructive macro backdrop, little hiccup, but yen carry trade unwind, real short hiccup, despite it being violent at the time. Now it's like, is that buyer still there in size down 20, 25, 30%? Is the buyer still there for Bitcoin? The last thing I'll say is I think what I think it probably hinges on is whether or not we're still in a broadly directionally constructive backdrop. If Powell had said it's time to retire the word transitory and we were going on an aggressive rate hiking cycle in 2024 instead of getting ready to start to cut interest rates and then cutting interest rates in 2024 like we got, would we have gotten the inflows that we got? What would the price action have been around Bitcoin? My guess is it would have been a totally different story. So
I'll tell you why I don't think this is going to happen. Like you'll get a bounce. I think the bounce is playing out right now. But this buyer base, they're long Bitcoin, but they're also long Tesla. They're long MicroStrategy. They also want to be long Palantir and NVIDIA. That's the buyer base. So their wallet has been pulverized. Let's look up Tesla. Tesla topped out and it was the leading at best or coincident at worst indicator for Bitcoin. Now you got a bunch of volume here. Maybe that's an arrow low. It's a question worth asking here. This is back to Alex's point, maybe QQQ riffs here. I can see that. But what I would expect is that this rallies and then it fails to get over the hump. I mean, it's still, these are still expensive, right? I mean, the crypto rally started when ETHE and GBTC were trading at 30-50% discounts to NAV, and it ended when MSTR had a 300% premium to NAV. And markets are trying to find the equilibrium.
Do you think there's real idiosyncrasies in Tesla stock because of Elon and because of what Elon represents in this Trump administration?
No, it's all animal spirits. It's all correlated. People are the psychology of the buyer that buys Bitcoin. They're banning in the future. They own. I could tell you their portfolio. You can see them on Twitter. Like this one guy, Shea Bowler, like his portfolio sucks, is getting destroyed. They can't help it. They're buying. They think they're buying innovation, and price doesn't matter. They're buying lunar stocks. They're buying variations of SpaceX in the public markets. So, and they don't know how to rotate and to other approaches.
Yeah, and going back to what you were saying, Travis, this is like kind of a noisy chart, but this is the flows on all the spot Bitcoin ETFs. And you can see down here in the bottom right, like it's just been nothing but outflows. We're at $4.6 billion in outflows for these ETFs since they launched. So yeah, no one's buying the dip really in these things. I mean, this is net flows, so on a net basis, people are selling. I'm sure there are people buying. I've talked to a bunch of advisors that have been looking at this space that kind of think they miss the boat kind of thing. So I think there are a decent amount of people out there that are like, well, maybe I didn't miss the boat, and they might be considering to add an allocation here at some point. That's what I'd be watching for, but I have a feeling they're going to wait to see like some of the shakeout. The people that do that, the advisors, they're waiting to make, a 1% to 2% allocation. And it's not something, they're not like watching the VIX like Ram was talking about for the most part. Obviously, Ram is an advisor in a way, but like I'm talking like these more model type based people.
We're not ordinary advisors. That's for sure.
Yeah.
I'll give you one other chart to look at as USD JPY. So, this was at the center of the Yen-Mageddon correction in August. It was one of the three stories that led to the Yen-Mageddon, correction, right? So I'll pull that up on screen here. But this represents, among other things, the foreign demand for U.S. equities, and call it like risk-taking, right? There are a lot of people in South Korea and Japan that love Elon Musk and Tesla. Like they love it. They love it. Can't get enough. And this also obviously funds a bunch of carry trades. So this is heading down. So the demand for U.S. assets decline. It's consistent with the idea that Europe and international markets have been rallying. Although I think, as I said earlier, I think those are probably topping out now. They've had their nice little spurt. Like this needs to behave better, right? And this is a margin call on U.S. asset managers and hedge funds that are long U.S. equities and borrowing in the yen. When the USD JPY drops, then your funding costs, you got to pay back in a currency that's appreciating. So again, I don't think we're going to get the same kind of dynamic in August, but it doesn't help is what I'm getting. Like on the margin, it just doesn't help. I'd like to see that improve.
I gotta say, I get asked a lot about the yen carry trade, like a lot, by people that before 2024 had never heard of the term carry trade. My understanding is it's been mostly unwound, and therefore it's kind of like it's even less important than inflation. Like inflation, it matters. The yen, we can forget about the yen for now. It's like this is a time to focus on Trump's headlines and nothing else. That's the way
I think Trump's headlines are number one, right? So two angles. Like I think the carry trade doesn't matter that much because people adjust. However, foreign capital has been a big driver of U.S. risk asset returns, right? People have, just in the same way everyone wants to immigrate to the U.S. and cross borders and do whatever it takes, in the same way, like European stock markets are going nowhere. There's like, how do I, and they've been there. I mean, there were ETFs that, I don't know if they still are the case, and maybe James, your terminal has this or not, but they were trading at premiums to NAV to access the U.S. market. The foreign demand for U.S. assets has changed. And since the Trump inauguration, it's been anything but that. Right? It's been the opposite. It's like U.S. down, so in foreign markets up. So there is a change in these trends and behaviors that we did not have before.
Yeah, make
what you're talking
Europe and China great again.
Make Europe and China great again is what we're seeing here, right?
Yeah, I mean, part of it seems to be like we talked about this last time. Was like Europe has to, if they're going to step up and like join in Ukraine, there's going to have to be a lot of fiscal spending from the European governments. And Ron, what you were talking about was the Chinese ETF. So there's ETFs listed in China, and unlike the U.S., they have like capital controls. So there's only a certain amount of like dollars that can go in, those ETFs can use to buy foreign shares. So there's a limit. It's basically like a closed-end fund. And as you said, like they were trading at 10, 15% premiums. They're still trading at premiums as far as I aware. I haven't looked in a couple of days, to be frank, but like they were trading at meaningful premiums because people in China were like, we need to get access to US markets, like serious premium. It's just bad investments, honestly, to be quite frank. But yeah, it's crazy. And it's been a complete change. I mean, I think we saw deflation in China in some of the most recent reports. So yeah, it's kind of crazy. Does anyone else have any further macro thoughts about what might be impacting things here? I think we talked about mostly everything. I mean, global money supply seems to be ticking back up a little bit.
We still finished the year up, I would say, for risk assets. I think the economic growth story is there, but I don't like the volatility. This is not like the August correction. It's not like the August correction because everyone's been trained to buy the dip, and Mr. Market's rug pulling all that trained behavior. I would say it's a complex picture.
Yeah, it's hard to have conviction around buying the dip when there's this level of uncertainty about everything that's going on with Trump. Full stop. Yeah.
Yeah, August was a pullback in a bull market trend, right? For the most part, there was a little bit of concern around what was going on with rates and what the Fed was going to do, and it was like concern about one thing. This, like we've talked about like 50 times in this episode, where there's concerns about what the hell's going to happen across like 50 different avenues. I mean, Travis, you've had a lot of tweets the last few days about like what Trump is doing. You had one tweet basically saying, still trying to wrap my head around how Trump has managed to piss off nearly everyone in crypto with his support for crypto. I mean, we didn't really get into like, what are your thoughts around like what's going on with this administration? I mean, Rahm praised David Sachs and what happened there in the meeting on Friday, but like, what are you thinking as you're looking at this space right now?
I mean, Bitcoin and alts are just so separate to me. They've been separate for a long time. They feel like it's more separate than they ever have been before. Bitcoin's really, I think of it really often its own thing, and has a set of risks around it, but also I think just has a set of potential buyers around it that is a totally different setup than when you look down market cap to anything else. Including ETH, even though they've got ETFs, and we're going to have some other spot ETFs here pretty soon, I think. But alts broadly have a core utility problem, and Bitcoin has found product market fit, and stablecoins have found product market fit, and everything else is somewhere between solutions looking for a problem and just vaporware grift. And there's a whole lot of stuff that's in between that. And until we can get, my view, which this is pretty new, just as of last February, we had the Trump win. Alts broadly did about a double in a month after Trump won. But they topped out first, second week of December. And then they went kind of sideways-ish for about 6 weeks generally. And then you had a real breakdown in February that has obviously continued now through March. And I think there was a question right after Trump won, when everything was ripping, there was a question about whether or not all of this positivity around the Trump administration as it relates to crypto broadly, not just Bitcoin, crypto broadly, there was a question about whether or not that was going to be sufficient to bring significant inflows into alts broadly. And what we now know, when you fast forward to February and saw the price action there, is that that was not sufficient, and that we did not have any kind of meaningful inflows into alts to a degree to kind of lift really much of anything, honestly, and certainly not any kind of broad-based inflows into alts. And I think the issue is that there's a lot of eyeballs looking at alts broadly, a lot of eyeballs with a lot of capital, billions and billions of dollars of capital. And they're looking at this and they're going, what is it that is going on in alts that is compelling enough to get me to put some money in, to get some exposure into this? And there's just not a good answer to that question right now. There's not. And people try and say some stuff, this, that, and the other. For a long time, it was like Solana was like the headline for that. It was like Solana. This is what you need to own in the alt. So you want to own the casino. That's what everybody wanted to say. You want to own the casino. Well, the casino that people were referring to for Solana was Pump Fund. And now what we've seen is that Pump Fund has magnified the worst parts of crypto and then metastasized the most degenerate, the most nihilistic, the most pointless, the most worthless. All Pump Fund has done is
just how you really feel, Travis.
And then taking money from, you've seen the on-chain wallet statistics for Pump Fund. It's like 99% of people that ever touched Pump Fund lost money on it.
Well,
and
same for NFTs in the last cycle.
What we've done is you could not have treated new entrants and retail into this market, you couldn't have treated them worse if you tried. Trump coin, Melania coin, Malay, Dave Portnoy, Central African Republic, Izzy fucking Exalia. You could not have treated retail worse than what we have done. And now we're sitting here, and do you really want to own that casino anymore? Oh, never. Oh, by the way, North Korea stole all the money from Bybit. They started laundering it through. They're laundering it through Pump Fund. Zach XBT found he did the wallet tracking, and now they're trying to move some of that through Pump Fund, which begs the question. Haven't seen firm evidence of this yet. Don't know if we're going to be able to find firm on-chain evidence of this or not. But there's a question about how much of the whole pump fund mania that we had over the last 12, 18 months, how much of that was just bad actors moving money around? If you told me that it turns out that some very significant portion of this casino that TradFi needs to own so badly, as it turns out, that is actually just like North Korean shit, wouldn't be surprised at all. That would be quintessentially crypto for that to be the case.
But a few quick reactions. One is same as it ever was. 2021, same thing. People bought NFTs. 2017, people bought ICOs.
Yep.
We it's funny if you think about the progression of these podcasts for the last few months. We talked about how, I remember Thanksgiving. My grandmother was like, "Should I buy Bitcoin?" Like, what? We never even talk numbers ever. We usually play card games or something, right? Then you have like sovereign wealth funds that are starting to leg in, and these sovereign wealth funds aren't the brightest people in the room. They're not. Then we talked about the proliferation of new product ETFs. James, you mentioned that. There are dozens and dozens of crypto ETFs. We talked about how when you have a proliferation of new product ETFs, that means you got to start looking for the exit. We saw that in the video too, by the way, like NVDU, NVDL, the levered long, levered short. Isn't that not playing out here? I just popped up like ETHE here. This is something we invested in 23, sold it in May. And I haven't looked at it in a long time. I just want to see how it's doing. But what I see here, putting on my technical analysis here, see what I see. This is massive rally from 23. You can see this when we were selling it. We're out. Here's our last trade. We're out there around May. But now this thing is selling back. And what's going to happen is this. All these people here that were buying, some of them are waiting for long-term capital gains, and they're just counting the days. This population is going to grow more risk-averse. And if this rallies, they will sell. They want to get out now. That pattern is true for many digital assets now. That story I just shared with you, big 2023, 2024, high momentum return. And now with just this technical breakdown below key levels, people have this regret feeling they're going to want to sell on rallies. So, and that, by the way, I think that statement is true for other momentum assets. It brings it back full circle where we started with. This is a momentum correction. And some of these assets, like you got Palantir at a 300 PE ratio, that's not coming back, guys. It's a wonderful business. CEO is amazing, great American. It doesn't matter. It's just the psychology of that buyer base is now broken.
I mean, what's really happening is, support is becoming now resistance in many ways, which is basically what you were saying. So like, we're all talking about this. Obviously, everyone's like, broadly, this episode has been very bearish. But I guess like everyone's pretty bearish, except for maybe on Bitcoin as an asset because
Alex
of all
is
the
bullish, right? Alex is bullish.
Alex is bullish on like a short term tomorrow. But I'm curious,
I'm bullish.
You guys are worried about. You said we'll be positive by the end of this year. I'm curious, like, what is your? I'll go to you first,
on
Travis.
Equities, on equities.
Okay, you'll be positive on equities.
Bitcoin's
Okay.
1 year return. Get ready for the audience listening. Imagine in your head, what's that number? Is 50, 80, 30? The 1 year return on Bitcoin year over year is 10%. So think about those holders. Well, they want to get back to even, and they bought late. They're late to the party. If you want to own Bitcoin, you got to be non-consensus. You got to buy when no one wants to buy. And the question is, well, isn't there blood in the streets now? I think if you proxy against other asset classes, the other asset classes are still expensive. That's the issue I have with it. The bull side is I look at uranium, it's totally destroyed. And I think uranium and Tesla and Bitcoin, they do move together. So there might be something there. Maybe. I think you gotta wait for this market to kind of prove itself and heal, get above these, as you pointed out, these resistance levels.
I'm not particularly worried about Bitcoin unless we get that macro path that I described, where you've got inflation coming up. You got to pull all the cuts out of the curve, and then people start thinking about hikes, and that would be the kind of path that would take Bitcoin 50% off the top. There was this question of whether or not the ETFs would change price discovery so much on Bitcoin that we would not do the full cycle drawdowns that we had seen in every cycle prior. Don't have a firm answer on that. Gun to my head, I don't think we would do. I would say we probably are done with the 85s, peak to trough probably, but I think we can do it down 50. Sure, I think we can go.
What are your thoughts on hedge fund redemptions?
What's
What
that?
are your thoughts on hedge fund redemptions? Like, the hedge funds that are down 40, 50%.
In crypto?
Yeah, in crypto.
Oh, the AUM of liquid focused crypto hedge funds is a rounding error. Nobody ever raising money. Nobody ever raising money.
So who's the marginal? What's the profile of the marginal buyer? Is it a RIA? Is it a sovereign wealth fund? It's not retail. I don't think it's retail. The best marketing for Bitcoin. Then the Friday was put the kibosh. The best marketing for Bitcoin is momentum. That's the best marketing for Bitcoin. So when momentum's not there, who's the marginal buyer?
I'll answer that real quick. I think the marginal buyer is these wirehouses, these brokers and advisors that you're talking about. I mean, for the most part, vast majorities of them, if you're in one of these places, if you're at a wirehouse, at a big bank or some platform, most of them still don't allow you to buy it for your client unless your client is asking to buy it for them, right? Like, so if I'm somebody there and I've been asking them to green light me the ability to buy, a Bitcoin ETF, whatever it may be, whatever ticker you want to throw out there. Now, I'm looking at this and I'm like, we're down 30-ish%, maybe more. We're under 80. Just give me the green light already. So I think that's the marginal buyer, potentially people who have been wanting to get a small allocation to it in this space. And they thought that it wasn't there. The problem is, how big is that and how long does it take before they can get to that point?
Okay, here's the home run hopium scenario. It's not I'm just outlining. Trump is saying we're going to go to Fort Knox and see if there's gold there. I expect there'll be gold there. It's hard to move a lot of bricks without someone in security tapping you on the shoulder. By the way, that doesn't help public anxiety either. That just does not help. Saying we're going to see if the U.S. government actually has, that does not help. None of that helps. So kind of goes back to, is Trump trying to talk down the market? But if Trump does say, hey, look, we're going to not have taxes on Bitcoin, and we want to have a settlement of value through Bitcoin, and he says, he's already said BRICS, if anyone's in BRICS, we're going to tariff you at 100%. He's already said that. BRICS is dead. And Russia support, can get on board with crypto. I have no doubt about that. But if he makes a sovereign push with China and Russia around Bitcoin, maybe I haven't seen any readings or evidence of that. But if we're trying to get what an exciting story might look like, that is within the Overton window of Trump.
To be honest, I put the probability of that happening at 0%. In 25.
When you say that, you mean the U.S. government actually buying Bitcoin on balance sheet? Is that what you mean by that?
Getting anything out of the government, the government is done. That's the message we got out of the summit. It's like, you guys are on your own. We delivered. We got the SEC out of your backs. You got your little SDR. Now you're on your own. That's the message I got.
What about on the payment side, Alex? Can maybe the U.S. government can do something around?
Yeah, but that's not crypto. And I think stablecoins. I mean, I'm still trying to figure out exactly how to make mine out of that. By the way,
I don't know. I don't know either. Let me know when you figure it out.
That's where the money is going to be flowing, but it's not really crypto. It's payments,
right?
Yeah.
So Alex, if you're one of the more bullish ones here, well, you think there's going to be at least a at least a short-term correction.
I'm thinking a 24-hour correction. Then
Yeah, okay, that's what I thought. Yeah, so you're not bullish. You're just like,
this is like maybe like March 2020. You know, it's like we got a very big dump, March 9th, 2020, and then the day after we rallied really hard, and then good luck. I really think it depends on Trump. So I'm just trading short term, following headlines, and I don't think I can't predict exactly if we're gonna go down 8% in a week or up 8%.
Where is the Trump put? Right, like we are now back to S&P 5600, and that is now below the election levels.
Yeah, I don't think it's that close, because I think that I'm guessing that one of the main factors that Trump is thinking about this through is that we need to get this pain done early, quickly, because you got midterms. You got midterms coming up in 18 months, and you got a narrow red wave right now. TBD on exactly how much you can get done with a red wave that's that narrow, and there's people that kind of flip flop sides. But if right now, a lot of this stuff, there's an inevitability to the tough medicine, right? There's no such thing as easy tough medicine. By definition, it's tough medicine. And that is definitely an accurate way to characterize components of what Trump is trying to do right now. But you would think that he needs to get that in a meaningfully better spot by the time we get to midterms, or Republicans could get smoked in the midterms, and then you're back into 2 years of gridlock in the back end of his administration, and then he's out. I mean, the fact that he does not have another term to run for is a ace in his pocket. It allows him to act in ways and do things that I think he never would have done if he could run again, because he's so obsessed with winning, right? It's like, you don't have to worry about that anymore. But the midterms, I think, component, and I think that could be a real reason why maybe it's like, we got all this shit that we got to get done. So it's going to be painful. It's going to be painful for Wall Street. It's going to be painful. And let's front load all this so that by the time we're in summer of 2026, a lot of this stuff is looking a lot better.
I agree. Look, the faster markets go down now, the better the market is next year too. And if you're Trump, wouldn't you lean into this? Wouldn't you say, hey, look, I'm not happy with the fact that the market's down, but while we're here, let me go fix up the mortgage market. Let me get the 10-year lower. Just lean into it. We'll blame it on the globalists. And Bessent's already on message. So, and there's actually a logic to that. Like the mortgage market is stuck, right? The 10-year is too high, and we got to control the deficit.
There's not a problem with that, though, in my view.
There's a problem. People are locked into homes that they can't move. They're locked into a relationship. No, it's a real issue, right? Housing affordability, one of the kitchen dinner items that people are addressing. Unless you're an all cash buyer, you can't have the American dream of having a home. It's a real issue. I mean, Bessent's talking about it 2 weeks in a row.
As somebody who's in his early 30s and a lot of his friends are looking to possibly buy at some point, it's something that comes up every time I hang out with my friends who don't have a house.
If you lower mortgage rates, it is stimulative for the economy too. I mean, you're going to get home builders up, building supply materials, construction contractors, small business, and it is Main Street. Those are Main Street, millionaire next door kind of jobs, and that crowd voted for Trump. So I think that's maybe he leans into it. Maybe I could see him doing that too. Then you get the 25% down Christmas, whatever it is, right? Like a month from now, let's say. I don't know. It's something I do think it's a great point to consider, though. He might just want to lean into it.
Yeah.
To me, that narrative makes no sense whatsoever. It's akin to a man trying to become less desirable to women by getting fat as fuck to spend less money on dates, and that's the old to save more money. It makes no sense You don't crash
Sure.
the
So
US stock
are
market
you
just
saying
to
okay?
get the yield a little bit lower for like 2 months, because as soon as the stocks go back up, yields go the other way. This risk alpha relationship is quite tit for tat, you know. So it's
Well,
I'm not buying that.
the other hop on issue is inflation. Like the number one issue people still talk about is inflation. When people ask about polling, they say, "Why is he not focused on egg prices?" The DNC response after the State of the Union said he's not talking about inflation. So if you want to solve that, you break things. Mortgage refi apps are up, by the way. They haven't recovered, but they are going up.
Yeah, but you need to keep it
Yeah,
there for
I
a
mean-
long time, not just for a couple of months.
But yeah, fair enough.
I think
Yeah,
the detox narrative is a new thing that they came up with after the fact, you know, to try to make them look
I
like
agree.
they're playing 3D chess when
I
they
agree.
just
I agree.
fucked up, you know.
They fucked up. Then here's the narrative, but then do they own it? And then like say, hey, maybe this is a path we take.
I disagree with that.
Okay.
The characterization that the Trump administration is fucked up over the last, we're not even 2 months into this, over the last 6 weeks. I disagree with that.
So you're saying it's a deliberate walking down of risk assets, or is it just a consequence of?
It's a consequence of
aggressive policy.
Yeah. You can really sum it down into like Wall Street's done whatever Besant said. Wall Street's done fine. Wall Street's going to be fine. We're focused on helping out Main Street, and they're making a lot of these moves right now. And there's a tough medicine component to it. And the fact that like all of us rich guys are sitting around like whining about our PAs, our portfolios, like get over it. Like we should just get over it. We've been winning. We've been winning for 15 years. We've been winning.
I think they front loaded the medicine. They've talked about rates consistently. When Trump walked away from the Zelensky meeting, he said that will make great television. So the visibility of Trump's not going to end. He is disrupting the legacy media by putting himself in front of social media all the time. That's their strategy. That's not going to stop. I think he's delivering all the tough medicine. Not all of it's even medicine. Like the geopolitical risk isn't actually medicine. He's front loading bad stuff.
One thing, tariffs are not really medicine; they're just bad policy. You know, we can go over that, but that's the thing that worries me.
Well, yeah, but Alex, you agree that there's
this belief. Yeah.
You agree that there's really broad disagreement over the statement you just made. I mean, that's your opinion. There's like real smart guys that are on the other side of that. So it's like
who goes on Maria Bartiromo's show and says, he's interviewed by Maria Bartiromo. He's prepped by staff. He knows he's going to get these questions, and he made a deliberate choice not to inspire confidence around a recession, right? I think this is none of us know the mental states of Trump, and I'm just talking out loud here, but I would assign maybe a 30 to 40% probability that they're walking down rates. And like Besant's got to sell a lot of treasuries.
So the one thing I would say is we got $9 trillion of treasuries coming due in 2025, right? That's the number we're at right now. And it's all been front loaded by Yellen. Under Besant was a chief critic of that. And he's been saying she shouldn't have done that, should have been more on the long end. But like if Besant normalizes that, that's going to do the opposite to the treasury rates theoretically, because you're going to be selling way more 10 years in long bonds than you otherwise would. So that's going to be negative on what they've been saying they do on a lower. The other thing I would say is, along with what Travis and Alex were talking about, like this idea that tariffs are bad I don't think it's even up for debate much in many regards. It's going to be bad for risk assets. It's bad for like a lot of companies and probably going to cause price inflation. But this is something like JD Vance, like if he was the president, he would be talking the way that Travis was saying and what Besant has kind of said. So this is a Trump 2.0 that's very different from a Trump 1.0 in the sense that JD Vance wants to, stop some of this globalization. He wants to bring something manufacturing onshore. I'm not really sure that's all that completely possible from my personal point of view, but that definitely seems to be a talking point. They want to do this via tariffs. I personally think, okay, maybe tariffs, certain things. They came out recently saying they were still going to do the aluminum and steel tariffs as they said they were. But these blanket tariffs on everything potentially coming in from everywhere just seems insane to me. Maybe do targeted if you want to do it, but they don't seem to care. They
Lutnick
don't
is
seem to
trying to
care.
walk that back. Lutnick is saying that we want a world where others will reduce their tariffs. And I would expect that India lowers their tariffs. That seems to be the first deal they're working on, which is good. So they have the right priority. The priority is lower barriers to open up markets to let American firms compete and grow. But I think, just coming back, like this 10-year, if you have tariffs, then China doesn't have capital to buy bonds, because when we import, we give them the US dollars to turn around and buy bonds because we're not exporting to them. We're not going to sell them F-35 jets. You got the USD JPY trending down. Now you have yields in Europe that are going higher. So they're in a difficult spot that they've created, right? How does your 10-year come down given that confluence of factors, which are created by their policy actions?
Well, tariffs is basically, like, quite literally bringing lower growth, which directly brings yields
They
lower.
really,
So
the question is, did Besson realize they effed up and they tell everyone? Like, guys,
Have you guys talked about the Mar-a-Lago Accord path on here before?
A little bit, yeah. Jim Bianco was on, but we didn't get into too much in depth.
This guy, Steve Moran, that just got named chief of the Council of Economic Advisors. That's Trump's nominee appointment for that role. And he wrote a paper that was like his
years ago.
No. He wrote a paper right before the election, right after the election. He wrote a paper. There was like his job interviews, like his job application. Writes the paper talking about using tariffs to bring our trade partners to the table, mostly China, because I think almost everybody else that matters falls in line. If you get China, most of them, or a lot of them, are will do whatever we say. It's like Japan is going to do whatever the United States says, regardless. So will a lot of people. But he did this paper. He also went on Felix's is it On the Margin, the Blockworks podcast.
Yeah,
he went on he went on that right after he wrote the paper. And if you guys haven't listened to that or read the paper, highly recommend that. He goes into great detail about the paper on the podcast. Super interesting. And the whole thing is that all of the tariffs, all of this is just negotiating leverage to bring people, namely China, but other major trading partners, to do a multilateral currency agreement a la a Plaza Accord, nicknamed the Mar-a-Lago Accord, because Trump would like do it at Mar-a-Lago or whatever, hypothetically. And that this would be a structural devaluation of the dollar. And it would also include this like treasury stabilization aspect of it as well, too, where you get China and the other people that are in the treasury market, the other foreigners that are in the treasury market, everybody kind of comes to agreement, make sure the treasury market doesn't have any big hiccups in it. And it seems like they're putting that, there's a question of like, if this was this guy's paper that he wrote, like Trump could have hired anybody to be the chief, of the Council of Economic Advisors, pretty senior position. It's like it's pretty senior. And he could have hired anybody, and he hired this guy that just wrote this paper. And then you start to see the moves that he's doing, and he's doing some of these moves around the tariffs. And then he like says he can do the tariffs, and we're going to push it back a month. A lot of deal making, a lot of classic art of the deal type of stuff that he's doing. And it's like, is the end game for this just to get to this multilateral currency agreement that finally gets our trade balance and deficit into a more sustainable position over, a multi-decade period of time, potentially?
So yeah, I listened to that. And so Steve Moran was at the Manhattan Institute, a conservative New York City-based think tank. Trump hired him because he supports his policy of tariffs. That's it. It flows from that. And Steve Moran, and I listened to that pod, and a lot of contradictions. You actually made the best case for the pod and things that actually made sense. But he also says, we want to stop China from devaluing their currency. But guess what? If you've got tariffs on China of 40% and they devalue their currency, they eat the tariff. Let them devalue their currency. That makes the product import cheaper, which offsets the cost of Americans paying for the tariff. So his paper isn't even it doesn't even make any sense, like logically. I just pointed out an example. You want to stop China from devaluing the currency? Let them devalue it 50%. We'll go buy China. We'll go buy some other.
But you're trying to secure the supply chain, and you're trying to onshore jobs, right? Those are
No,
two.
no. Listen, the dependency on China doesn't matter. So I'm actually not worried about China tariffs. Like, raise tariffs on China. They're a bad actor. They're hacking American business, stealing IP. Their espionage encroachment is off the charts. They're a bad actor. They got to be dealt with appropriately. Okay. Now, the real tariffs are Mexico and Canada. Now, you can do some. I did some research over the weekend on the cost of a Mexican car worker. It's $10,000. 65% of the cost of a car is labor. Now, you bring that job to the United States after you add in OSHA, prevailing wages, and union, and supervision costs, and coffee break costs, and no one's doing 12-hour work weeks. That cost of a car is going up, and what you can create a $60,000 job, so it hurts the consumer. You're not creating a high-paying job. That's the fundamental thing. To the extent it's high paying, it's because of non-market forces, which hurt consumers' well-being. We're not trying to import $10,000 jobs from Mexico. It makes no sense. Taiwan Semiconductor, I get. That makes sense. That deal made a lot of sense.
Prescription drugs.
Europe is free riding on American prescription drugs, but with generics. Yep. That's got to be fixed. Europe is riding on America's defense umbrella. Yes, that's got to be fixed too. But part of that equation is right into the U.S. dollar, but that's part of the trade, right? Use our currency, and we're going to take care of things and get to run pole position on the direction of the travel, for world.
Travis, thank you for joining us. This was fun, and it's your rant there before was very enlightening. It was enjoyable to listen to. Very passionate about altcoins here. All right, guys.
Just call it like I see it. But thanks for having me, guys.
Yeah, thanks for joining us. This was fun. We'll have you back. All right, thank you for joining us for this episode of Bits and Bips. We'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, everyone.